Welcome back. Our co-hosts in this second hour of the program. He is the owner of this establishment, Michael Hornby.
Thank you, sir. Good to be here.
Jefferson County Prosecuting Attorney Matthew Harvey.
Good morning.
Who threatens to get jurisdictional duty in Berkeley County at some point along the way.
Some creative way, like just over WR&R.
I think it would be good, like an
do
island, kind of like
do a little annex down the yellow line, down
West
45,
Berlin.
come up.
Surrounded on all sides.
Yeah.
They'll annex you out.
Yeah, or I think that's for taxing purposes. I'm not sure. Yeah, good to have you here either way.
It's great to be here.
Our guest in this segment is Marc Savitt from the Mortgage Center. Marc, good morning to you.
Good morning.
When we have questions on interest rates, and we need some humor with it as well, we go to Marc Savitt. He's got the most one-liners of any mortgage guy you're ever going to talk to.
I was related to Henny Youngman.
Take my wife, please. Marc, we've been in a interesting mortgage market for the last, 2 years now?
3.5 to be exact.
3.5, right? We've been kind of around 6-7% during that time?
Actually, they have gone as high as almost 8.5% when the Fed started to raise rates.
Where are we now?
We are, depending upon, there's a lot of factors involved, depending upon the program, government loan versus a conventional mortgage. Government loans are always a little bit less expensive. Credit goes into it. If there's a down payment involved, things like that. But we are, well, today's what, Thursday, right?
Thursday, May the 8th.
Right. And this week we've locked in 3 loans. They're all government loans, VA to be exact. And they were all in the mid to upper 5s.
That's a good rate.
Yeah.
Wow.
Yeah.
I mean, historically, we had some really low rates a couple of years back, but those were unusual, weren't they?
Well, yeah, they were created by the Federal Reserve Board because they started to purchase the mortgage-backed securities. So because of that guarantee that was there, the lenders across the country dropped their rates into between 2 and 3. Actually, we saw some of them around 1 3/4 at that time.
Wow.
Right.
My first was 10.5, and my second and third ones were around 6, 7, 7.5. I think the second one was 8.5 actually.
My first mortgage that was back in '83, I believe it was 12.5%, and I was glad to get it because 2 years before that they were 18%.
I remember my cousin had an 18% mortgage back around that time, which was historically high, obviously.
Right.
Yeah. So, any idea what the trends are right now? Have they been trending down, up, or steady?
It's like a moving target. Last year, around June, July, the yield, that's what a good indicator of where the interest rate's going to go, the yield on the 10-year Treasury, dropped down to in the 3.7 range. And we were doing loans, especially government loans, at about 5% with little or no points. So it was really very attractive, obviously, at that time. And then all of a sudden, rates went back up again. There's no rhyme or reason for it. Things, I've been doing this, almost 40 years. And when I look at the way things should be versus the way things are, nothing makes sense anymore. But I think the clouds are starting to dissipate a little bit, and we're seeing things like right now, I checked before I came over here this morning, the 10-year Treasury was trading at 4.31 something, maybe 1.6. So it's moving down. Yesterday it was a little bit lower. The Federal Reserve Board came out yesterday. We all knew that they weren't going to cut the federal funds rates, the short-term rates, which is not more, for those that don't understand that, it's not mortgage rates, it's short-term interest rates, like your HELOC if you have one. Yeah. But what happened after, which is more important, is when the chairman comes out and he answers questions. He reads a statement and he answers his questions, or the questions from the press and so forth. And he said that they're going to be steadfast because they're concerned about inflation, but they're also concerned about where unemployment is increasing a little bit. Continuing claims on unemployment is getting higher or not being reduced. So he's concerned about that. My problem is the Federal Reserve Board back a couple of years ago when they started to raise interest rates, we had, I think the highest we got was 9.1% on inflation. If you remember before that, the Treasury Secretary came out, Janet Yellen, and also Jay Powell, who is the chairman of the Fed, came out and said, this is just transitory, so we're not going to do anything about this right now. I think that was a mistake. He should have jumped on it back then. That's what caused the inflation to get as high as it did. Now I think he's going in the opposite direction. Right now, he could have cut maybe by 0.25% yesterday. He's already taken June off the table, maybe July. The problem with that is there's a lot of people out there that had to take HELOCs, credit cards are maxed out, things like that. And people, the consumer needs some relief. If you were to cut by 0.25%, it's not going to cause inflation to go up. He's also said that he feels as though we could have a problem with the tariffs causing additional inflation. It's possible, but the people that I've spoken to said, well, if the prices just get too high, then I'm just not going to buy. So you may have things cost more, but you're not going to have the consumer purchasing. The consumer's already pulling back. Consumer confidence is a lot lower than it was last year, when there was some hope that things might get better. But having said all of that, I feel as though what's going to happen, and maybe even today, I think at 10 o'clock this morning, Trump's coming out with a news conference where he's reached a deal with the UK on the tariffs. From what I hear, there are several other countries that have already reached a deal. They just haven't, put their signatures on it yet. So things are improving in that department. But I think what he needs to do in order to show some confidence to the consumer that things are going to get better is come out and let's state who these other countries are, and
you're talking about Trump there,
right? That it's getting better. He's also, I think, was it this weekend in Switzerland? They're meeting with China. That's a big step. It was back and forth. It was like watching pickleball there for a while with the tariffs going back and forth.
or worse, hearing it.
Yes.
And China said they were not going to negotiate.
They're still saying that, but yet they're
But they're going to
with
negotiate. Well,
Geneva, yeah. 10 years at 4.289, by the way, as we speak.
Oh, very good.
Yeah,
Got better since I
4.289.
left the office this morning.
And you touched on it there for a moment.
I would say the market's reacting to you being on here. That's why that's improving.
I like to hear
Well,
that.
tenure.
How long can I talk here today?
You can go all the way up until 9:31. Yeah, so 17
rates
more
will be
minutes.
back in the fours again before I get out of here.
Yeah, you touched on it a second ago, Mark. If you could expand a little bit. When it comes to mortgage rates, many people react to what the Fed chairman does with the prime rate as opposed to paying attention to the 10-year.
Correct. The Federal Reserve Board chairman, in my opinion, has a tremendous amount of power. We see things, if you watch the final, and I'm looking at what you're watching right now, that's what I watch in the morning.
Mm-hmm.
The different members of the board, the chairman usually doesn't speak too much in between meetings, but
Right.
you have other members of the board that come out. In my opinion, everybody's looking for their 15 minutes of fame, and they get up there and they make statements, and you can have two different members of the board and they contradict themselves, so they're creating more uncertainty in the market. And that's the one thing that obviously consumers don't want to hear, businesses don't want to hear. But when the Fed chairman comes out like he did yesterday, I mean, everybody tunes into this thing. They listen to every word that he says. They try to interpret what he says, even if he's ambiguous about whatever statement he's making. And if he's doing a good job, he will be vague about things. So my personal feeling is that things have started to move down slowly. You'll get a bump up every once in a while. But I think once the issues with the tariffs are taken care of, because if it doesn't create more inflation, then that's the one thing that is the worst thing you can have for bonds right now, because inflation erodes the value of bonds. The target rate for the Fed is 2%, and I think
It'd be hard to get to.
Well, we're at 2.4 right now.
Yeah, but they've had a hard time getting it below that number for a couple years. Powell's been pretty stubborn about that 2% number, and we're not there.
Right. but we're not that far from it either. It's like I said before, he came out, he was, in the beginning, he was behind the 8 ball.
He was slow.
He was slow.
He was slow to raise rates.
They didn't want, they say politics doesn't play a part in this thing. Politics plays a part in everything. Right, Mike? It was transitory because he said it was transitory. Then Janet Yellen, who was a member of the administration, the previous administration, as the Secretary of the Treasury, came out and uttered the same thing, that it's transitory. So nobody worried about it. Oh, it's just because of the last remnants of COVID. We're going to have this problem. Let's not worry about it. They should have jumped on it then as a precaution. They wouldn't have had to raise as much as they did, and it would have been a lot easier to absorb into the economy. But they didn't do that. Now he's going, like I said, in the opposite direction. He doesn't want to cut. He's being stubborn about it because he's afraid he could maybe end up in the same boat again. I also think there's a tit for tat between Powell and Trump. Trump's jumping on him, you need to cut rates, and he's trying to show that he's independent. He's not going to cut rates. So hopefully that'll start to fix itself today. You said the yield is already going down. If once the administration, like today, when they come out about the UK, and they start naming other countries that they've reached a deal with, I think it's huge, as I said before, with China. That's the biggest player in all of this.
Sure.
So I know that Vietnam, they've reached an agreement with. They've reached an agreement with Israel. I forget the other countries right now, but there's a couple of other countries. They just haven't publicly announced it yet, and they need to do that.
Marc Savitt from the Mortgage Center, our guest here on the program. Go ahead, Mike.
Mark, we had a really interesting conversation with the Jefferson County Commission the other day regarding impact fees. Berkeley County is looking into introducing impact fees for new homes and new builds in Berkeley County. From your perspective as a lender, does that now make every new home, let's just use $10,000 as an easy figure, $10,000 higher, and now you have to mortgage those $10,000? That $10,000, does the appraisal fit that? Because if they have to charge it, every new house is worth $10,000 more? How does that work, and how does that correlate with
it's all about, first of all, what it does, it erodes further from affordability for the consumer. But what happens is when you put it into the sales price of the houses, which what they're doing, they're passing it on.
Yeah. Which is obviously what they would do.
Right.
Yeah.
Right. They're not going to absorb that. That's a lot to absorb.
Yeah.
But what you're doing is you're knocking a certain an additional segment out of the home buying process, because some people that are right on the line, they can I don't want to say they can barely afford it, but they're very close to not being able to afford it. So by adding that in, the problem you have with the prices, the new prices, you have to have comparable sales in order for the house to appraise to what that is. And every time they add something that significant, it takes a while for the comparable sales to catch up to it.
Okay.
So you could have a problem in the beginning where the houses may not appraise out, which means the builder has to either reduce the price, or the consumer has the option of walking away, because we go by the sales price or the appraised value, which is ever lower. That's what we base their loan off of.
And the average mortgage that you're financing right now, I know it's a range, but what's the average amount of a house in Berkeley County, or a mortgage that you're financing in Berkeley County?
It's most of what we do are at a minimum or in the 300 to 350 range.
Okay.
And that's minimum. And those are houses, I'll be honest with you, we look at the appraisals when they come in, we see what they appraised at, and we shake our heads and we're like, wow, because, of course, we've been in business a long time, and we go back to the early days where new homes were $65,000. Right. So you know what I'm talking about.
I do.
To our friend Joe.
Yeah, Wildflower Creek Estates,
So,
$70,000.
So an average house, let's say $350,000. What do I have to make as a person to afford that?
Well,
mortgage?
that's hard to come up with that, because there's other
Really?
factors involved. You have debts and so forth too.
Okay.
So that's really hard to. You're not going to pin me on that one.
Well, I mean, an average family let's say in Berkeley County, the median income is 70+ thousand, I think. Is that salary enough to own a home in Berkeley County?
It takes usually for a house, say 350 to 400,000. It's going to take both if there's a married couple, it's going to take both of them to be able to afford that house.
I want to go back to impact fees for a second, Mark. This came up yesterday in a question. When you go to settlement, closing on your home, do the impact fees show up on the closing statement as a separate charge, or are they just rolled into the purchase price of the house?
It's the builder will roll it into the price of the house, and he'll tell the consumer, because the prices have gone up substantially. He'll say, "It's not me, it's the county, and this is what they're charging me, and I have to pass this along to you too." We have other issues too with that, and this is kind of a pet peeve of mine. We have a lot of the big builders, the national builders that are building here versus the homegrown.
Local guys.
I don't have a problem with homegrown. So we have these builders that come out and say, "We'll give you, Mr. Consumer, Mrs. Consumer, we'll give you $10,000 towards your closing costs, but you have to use our in-house lender or our preferred lender." The problem with that is they're building it in. The Real Estate Settlement Procedures Act said you can give a discount, you can give an incentive, but you can't make it up anywhere else in the transaction. If you do, it's a violation of RESPA. It's an actual law.
What's RESPA?
Real Estate Settlement Procedures Act. I've got another version of that, which I'll tell you later, that I used one time when I testified before Congress, and Barney Frank threatened to throw me out of the room.
I remember that story.
But anyway, so what they do is they'll if you're using their in-house lender, and we see some of their loan estimates that come in, we look at what they're charging versus what we charge. In some cases, and I won't mention names, but in some cases, the interest rates are anywhere from maybe 0.5% to 1 1/8% higher than ours. Those are the interest rates. Then they'll charge what we call junk fees. They'll charge a processing fee of $2,100. So you can see where they're starting to make it up. And under RESPA, you don't have to make up the whole thing, but if you make up any part of it in the transaction. And let's face it, what builder is going to give you, you mentioned $10,000 before in impact fees, what builder is going to give you $10,000 just to use their mortgage company?
And why?
Right.
There's a reason.
Well, we know why. I had a conversation with somebody who we took over a loan from one of the bigger builders because we actually had a better deal, and they said, "Look, it's going to, you're not that far off. I'm getting a much better interest rate with you, and we're going to use you." So they immediately told him, "You're not getting the $10,000." And he saved a lot of money by doing that. But it's this illusion. They put this shiny object in front of you, $10,000. Wow, I'm going to do that. Well, you're going to be paying more. And it's not just the interest rate. What they need to look at is how much is your housing payment going up? So there's problems with that. And we've spoken to different regulatory authorities, particularly the CFPB. The CFPB, it's
They've kind of been gutted, haven't they?
Well, yeah, I was in Washington a couple of times. Washington, February, and then one in the beginning of April. The sign's not even on the building anymore. It's kind of like, they're semi-retired now. They're only working a couple of days a week. A lot of people have problems with the CFPB. I don't, because there needs to be a regulator. Sometimes they were a little bit overbearing. But we still need to have a regulator that will keep some of the bad actors in check. Because right now, people are running around out there. The bad guys are feeling emboldened right now because nobody knows who to go to if you have any issues. But that builder thing really needs to get under control because the consumer is being ripped off.
Now,
I'm sure I'll get phone calls on that.
Is that a federal issue? Or is that a state issue?
It's federal.
That's federal, right?
Okay.
Yeah.
So the CFPB was created after the mortgage banking crisis, correct?
Right, under the Dodd-Frank Act.
Right. And interestingly enough, Dodd-Frank, I know when you testified, they had as much to do with the mortgage banking crisis as the other factors did.
They did.
Yeah, but they were
actually not Barney Frank. It was Chris Dodd.
More Dodd.
Yeah.
But they were created out of that But what were the protections before that was created? Who was protecting the consumer trying to get a loan before the CFPB came around? Because they were only, 15, 20 years old.
Right. Well, not 20. Yeah, about 15. It was HUD for the most part. You also had different state regulators that would take care of it too. Banking departments, other agencies, the attorney generals of the states can do that. But HUD had RESPA. They created RESPA. And as a matter of fact, interestingly enough, the fix for that problem with the builders, I was working with HUD for many years on that, trying to get them to fix that. They did fix it back around 2009, something like that. Mm-hmm. They had RESPA reform where they didn't change all that much, but they added that to that because you could not require somebody to use a specific settlement provider, whether it's a mortgage company, a title company, an insurance company, whoever. If the builder could not compel you to use them in order to get whatever incentive or discount they were giving out. And the Home Builders Association came in and sued them, and HUD just ran away with their tail between their legs and never fought it. They dropped it. I've had white papers made up from different attorneys in Washington, from some of the biggest firms in Washington, say it's a definite violation. The law is clear. It says that you can give an incentive or discount. You can't make it up anywhere else in the transaction. And there's a thing called required use. You cannot require someone to use your particular your particular mortgage company, title company, whoever. So I think we have some violations there on both sides. I'm not an attorney, but I have testified many times before this in front of Congress. I've spoken to different members of the House, the Senate. Everybody agrees with me, but nobody does anything because the home builders is a very strong lobby. So this is another thing that we can do to make homes more affordable and I think better for the builders. You can compete builder to builder instead of trying to lock them in, make them captive into a bad situation. And my feeling is, I don't have any proof of this, but I see it every day. If you are a preferred lender or the builder's lender, and you've got somebody who wants that $10,000 or whatever, the incentives are actually going up a little bit. If you want that money, then you're going to pay whatever the lender puts in front of you. You have to go along with it. If you don't get the money.
Got about a minute left. Mark, how can folks get in touch with you for more information about getting a loan?
Well, two ways. One, you can call our office at 304-267-9040 or our website at mortgagefinancing.com.
That's an easy one to remember.
That's right on the shirt.
It's good shirt, yeah. And what are your hours of operation, sir?
Normal hours of operation, Monday through Friday, 9 to 5. But with technology, I field phone calls and every day of the week after hours. So if they need me, they can call me. It'll give them on the answering machine when they call the office. It'll tell them if they have a problem, need to speak with someone right now, hit number 5, and it goes right to me.
Good to see you, Mark. Thanks for coming in.
Thanks for having me.
Mark.